Good morning and welcome back to the latest edition of the InvestTalk market analysis for the week ending February 28th, 2025. Yes, we are through the first 2 months of the year, and it was an eventful couple of months. And this week I'm titling the video "Markets Confirm Downside, but Near-Term Support Holds." So we'll talk about that on the charts of what the underlying market is telling us about the future path of markets and this year. It's still murky, but you're starting to get a clearer picture. Let's say that. Uh, I'll start off though with. By the way, I'm Justin Klein, host of InvestTalk, and I want to start off with the economic numbers as usual, but the heat map will come first. And this is the week. So you can see a lot of red, but a lot of green as well, right? You have consumer non-durables in the top right. All those were pretty strong on the week. Same with healthcare. Consumer services mainly faring fairly well. Utilities obviously very green. But the big names, big names was dragging down the markets right now. Tesla down 17%, Amazon 5, Nvidia 11, Apple nearly 2. Best of the bunch definitely there. Google down 8, Meta down 4, Microsoft down 5. So, just a lot of big reds here, right? A lot of small greens, a lot of big reds. So you can see kind of mid caps, small caps doing a bit better than those mega caps. Now let's dig into the economic numbers. You had the manufacturing front, two reports from Richmond Fed and then the Kansas City Fed. Mixed bag. Kansas City Fed was deeply negative. Richmond Fed bounced back into positive. So a mixed bag there. Home sales, new single family home sales did tick down a bit, but we're still kind of in this range here, between, call it 600 and 700,000 per month. So the housing market's not getting off the mat. You can see that with the pending home sales year over year. So this includes not just new, but existing, 2 months in a row at negative 5%, which is, there's some base effects here, but it's clearly the housing market it continues to struggle under the weight of poor affordability and 7% mortgage rates. Durable goods new orders that did tick up a bit, which was in contrast. Now, this was January, so it's a bit old at this point, right? So what happened in February, and we'll dig into that. The initial unemployment claims that did tick up to the highest level since December. So this is something to watch for if this breaks out, as well as the continuous claims that actually ticked down, surprisingly. So we're still kind of in that range here. Jobs market, okay, but certainly not terrible, not amazing, just kind of hanging in there. The US PCE price index that ticked down to 2.5. That's what the market was excited for on Friday. Got the bit bounce back, and that was a bit dovish. At least expectations were a bit dovish for Fed policy. So you got a bit of a bounce. I think that was the catalyst here. 12-month mean trend PCE, that's something that the Fed watches. That did tick up though, but still, below that 3% mark, but obviously not heading in the right direction. This is interesting. Personal spending month over month down in negative territory for the first time since March of 2023. And we'll see if that's a flash in the pan like it was then. A lot of it could be under about uncertainty. We know consumer sentiment and consumer sentiment a week before was poor, and that's what could be driving this, because the personal income, that was actually up month over month, nearly 1%, right, accelerating in January. So it's not really, the spending is not really matching the income here. But we'll watch this to see if any durable trends come about. Now on the Fed front, you are getting now a very high likelihood. You're about 82% now. There will be at least one cut between now and June. Now the March meeting that's coming up on the 19th, that will most likely they'll set the stage for ending QT is my best guess. And then we'll probably see how the market reacts to that, and then potentially proceed with more rate cuts, maybe in May or June. Right now there's still no rate cut set for March, and usually these type of meetings, when there's nothing really expected, that's when they set the stage for expectations in the following meetings, right? So that's what they like to do. They don't like to blindside the market. They want to signal that they're going to do X, Y, and Z in the next, in the upcoming meetings. And so that's what's likely here. With that said, let's pivot over to the charts. I'll connect that to what we're seeing on the in the Treasury market. Right, Treasuries are rallying, bonds are rallying. Here's the IEF, here's the BND. Bonds are certainly doing better on more rate cut expectations and the potential for a recession. Actually, I want to head over. Actually, I want to show you this because this is something I talked about, which is the GDP now, right? Everyone talks about this, and this is, pull this up here. There we go. And this is now negative territory, negative 1.5%. Now, the reality here, this is mainly driven by net exports. Okay. So you can see this here. Net exports fell from negative 0.41 to negative 3.7. And remember, there's a GDP calculation is G plus I plus C, sorry, C plus I plus G plus net exports. Okay. And if net exports are negative, then that's a drag. And our net exports are negative, so it's always a drag, but it's even more negative right now. Why? Because companies are front loading inventory ahead of potential tariffs. And so that blew out our deficit in January. And so that's what you are seeing here. And I would say deficit, trade deficit, not spending deficit, trade deficit. And so you might get some headlines around this. This is not telling you that we're going into a recession. This is at least for now somewhat of an anomaly, because if I pull up, let me go pull up some charts here. Here we go. Here is short-term junk to short-term treasuries. This is still an uptrend. Yeah, it's weakening. Could it break down? Absolutely. But you're not getting a credit market event at the current time. Okay. You're not getting anything like that. So let's go look at the major indices. The NASDAQ is the one you want to follow the most. I talked about this, how, you're in this choppy bearish range. And as long as you're in this is breakdown from December 18th. As long as that is the case, you are likely to see more downside volatility. That's what these lines are. If you go back to previous videos, these are saved in here. And so this is, once it breaks the low in that range, this is the expected measure, what I call measured move, which would be down here around 1700. Now you did get a bounce, nice bounce off the 200-day moving average for the NASDAQ. That's what I said. You held short-term support, but this is the new line in the sand. Let me clean this up. Well, actually, I'll leave that. But let me add another line here, which is this high. Okay. This is the high from Thursday, that big breakdown. And you got to bounce. But bounces are not unusual. Even strong bounce in a downtrend, strong bounces are very common, right? It's a matter, are you breaking back to the upside, breaking any of that overhead resistance? And this is the new overhead resistance on the NASDAQ, right around 19,200. Okay. The actual number is, what's the high? 19,242. That's the new high. That's the new resistance, the upside. You start getting above that, maybe this is just the end of this little pullback. Certainly possible. Absolutely possible. Okay. But something to watch. NASDAQ, same thing, right? Sorry, not NASDAQ. S&P, same thing. Similar chart pattern. It's not making a lower low. Okay. But I'll be watching to see if we get above Thursday's high, right? Go back to the NASDAQ. You are making a lower low. You are making a lower low here. Okay. So that's something definitely to take note of. Now let's go to a monthly chart. I want to do that because we did close the month. Okay. Now, this isn't a major reversal. Okay, let's show this. So we're not below, we didn't close below, I don't think. Let me zoom in here. Yeah, we didn't close below the January's low. We didn't close below that. So that kind of saved markets a bit, right? That, this wasn't a wide-ranging reversal. Let's go to the XLK. This is the monthly. Ooh, this is getting close as well. It's getting close as well. Wrong way. Wrong way. Zoom in here. Yeah, this didn't close below that either. So this is, like I said, this is technology. But you can see the MACD rollover, very similar to what you got at the end of 2021 into early 2022. So is this the start of the downtrend? Well, on a weekly chart, you would say yes, because you got to confirm. You did get a reversal candle on, I believe it was in the NASDAQ, if I remember correctly. Yeah. So you got that big reversal candle on last week, and then you got a confirmation this week. So, this is definitely looking weak, but it's holding support. And it can hold support for a while, just as, go back to here, back to a daily chart. Just as, this chop sideways for 2 months before you got a breakdown. That could happen again, right? Before you get another breakdown. Or once again, it repairs itself and this is just a modest pullback. That's possible, right? That this was a yen carry trade unwind type of situation that you had in July of last year. And speaking of that, let's go over to the yen. Could be part of the problem here, right? The yen is strengthening. Okay. The dollar is weakening. But you're getting dollar now on the upside. Could that be saving markets? Potentially. Absolutely. Right. Let's go to the move index. This is also moving higher. Pun intended, I guess. If this starts to materially move into the 120s, 130s, you especially up to the 150 level, that's where things get unruly in the charging market, and then you really get a risk off scenario. Okay, but we'll be watching for that. Let's pivot over to gold. Gold did a little pullback here, but nothing wrong with this, right? Just it was overbought, absolutely overbought. Look at the strength of the MACD. Okay, let's go to the weekly chart. This was a nice little sell-off here, but we got one back here in November. You had 2 weeks of that, and then it's resumed back to the upside. So, it's overbought on the weekly chart. Could you start going into a consolidation period in the coming months for gold? That's certainly possible. Definitely possible. A lot will depend on the dollar. A lot will depend on rates. But as long as the dollar doesn't get materially stronger, as long as you don't get a strong rise in interest rates, those two things would be headwinds to gold prices. China, Russia, uh, entities around the world are starting to diversify away from the US dollar system, and they're doing it with gold. Gold deliveries around the world are massive, and you just continue to get strong gold prices, and this trend is, I think, very durable. So there's that. Let's go to the GDX. So here's the weekly chart on the GDX. We're not getting a breakout quite yet, but I'll be watching. This could get some interest, right? Pull back here. This really needs to break out. With gold prices it should break out based on where gold prices are. So we'll be watching for that. What else do I want to get to? Growth to value. So we know growth has bounced. Zoom out to a weekly chart here. So this was 2021. This is where the growth peaked out, and since then value's been outperforming. But that's because 2022 value crushed growth, and so it's had that bounce back. But we're making what you see here is a lower high, and we'll see if this rolls over. But it's looking like it is, and so would that mean the Nvidias of the world are going to roll over? Nvidia had earnings. It initially was greeted positively after hours, opened up, and then faded. And this is pretty bearish. Okay, it's a pretty bearish chart on Nvidia. And they had good earnings, just not as good as expected. Right? And look at the MACD, very negative here. Okay, and sold off on volume last week. What else? Let's get to Bitcoin. So Bitcoin did roll over. I bit. And actually, let's go over to, let's go back over here. Let's go take a look at Bitcoin real quick. Where are we at today? 85. Okay, we bounced back. There was support around 80, but if we zoom out to a yearly chart, right, this broke that 90,000 level. Could repair itself, get back over 90,000, but as long as it stays below 90,000, this is definitely in a bearish territory. Okay, so just a heads up there. Let's look at the sectors real quick. I already looked at XLK, but industrials are interesting. Those are making a higher low here after that pullback. So I'm kind of liking industrials a bit at the current time. Utilities, that's strong. You're seeing consumer staples also remaining strong. But then if you look at XLY, obviously this is Amazon. This is kind of rolling over. So this is the consumer discretionary. You see this is Amazon certainly weighing on this. But discretionary is definitely on the weak side. Energy has been, surprisingly hanging in there, right? And a good strong week. So you're seeing that rotation into the value side, even though oil has been relatively weak. XLE is kind of hanging in there, and we're at support. This is the USO. So I don't expect imminent downside. I expect weakness into March OPEX at least. I've said this. I expect this to be a choppy year. So to see a sell-off into support, it's not shocking. And we haven't really broken any major support, right? The Nasdaq at the 200. We're not even at the 200 in the S&P. Okay, so now once again, could this be a topping process and you go into a deeper correction later in the year? Absolutely. I've said that the back half of the year is a riskier time in markets than probably the first half of the year. But it doesn't mean you can't get these sell-offs, especially in relation to policy coming out of the White House that is creates a lot of uncertainty, one way or the other. Whether you like it or hate it, doesn't matter. It creates a lot of uncertainty because he talks about tariffs and he backs off and then he brings them back, and then there's geopolitical issues with Ukraine and Gaza, etc. And it's all over the map. And when it comes to and how that relates to the economy, okay, and so that's naturally going to bring more volatility. Markets don't like that uncertainty. Okay. So what I'm expecting is support to probably hold in the near term, choppiness. But in general, the easy money over the past 2 years has been made. Can this turn into a consolidation period for another move higher? That's also a possibility. That's also a possibility. And right now, I lean bearish, but it's a slight lean. It's not I'm outright bearish. Everyone needs to go to cash or anything like that. You just have to call a spade, and really it's about the tech sector really weighing on the markets. Right, here's the Nasdaq. Right, we know that these are the heavyweights in the markets, and if they are struggling and they are losing momentum, the market will naturally lose that momentum. Now, could other parts of the market take up the mantle? Absolutely. I talked about this, right? Go back to here, right? This is the weekly. There are other parts of the market. There are other opportunities that are in markets, right? From industrials, you see that some good green here, communications, healthcare, non-durables, utilities, etc. So it's not like you want to throw everything out, but it's certainly a tougher market, a choppier market, a more volatile market, and that's what you should expect going forward. Well, that about does it. Appreciate you all tuning in, liking, and subscribing to this channel, as well as our podcast, InvestTalk. And a reminder, the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell a security or to participate in investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Have a wonderful weekend.